Ladies and gentlemen, prepare to dive into the enigmatic realm of investing as we unveil the legendary Warren Buffett's most coveted secret. In a world where markets sway like a tempestuous sea, one man has consistently navigated its ebbs and flows with unparalleled finesse, amassing a colossal fortune that defies comprehension. Today, we unravel the mystique surrounding Warren Buffett's investment prowess, a secret that has eluded many, yet holds the potential to revolutionize your financial journey forever. Warren Buffett, often dubbed the Oracle of Omaha, isn't just an investor, he's a living legend. But what sets him apart? Is it luck, intuition, or an uncanny ability to predict market trends? The truth lies deeper, and it's far more astonishing than you might imagine. Beneath his unassuming demeanor lies a set of principles, a philosophy that transcends time and remains as potent as ever. What if I told you that this sage of investment doesn't rely on arcane rituals or crystal balls? Instead, he follows a set of timeless principles, a secret recipe meticulously crafted over decades of astute observation and unwavering discipline. Get ready to witness the embodiment of financial brilliance. Stay tuned for an expedition into the heart of Warren Buffett's investment enigma that will leave you awestruck and empowered. Like, share, and subscribe to embark on this transformational journey together. Whether you're a seasoned investor or just starting your journey, join us as we explore how to navigate the market with the same shrewdness and wisdom that has propelled Buffett to greatness. In the world of investing, there's a sage piece of advice that has stood the test of time. Invest in what you understand. This timeless principle, championed by none other than Warren Buffett, carries profound wisdom that has led many to financial success. When you adopt this approach, you're essentially staying within the boundaries of your circle of competence. Imagine yourself as a detective, seeking out opportunities that fall under your expertise. Just as you wouldn't try to solve a mystery outside your field, Buffett encourages you to stick to investments that you truly comprehend. This strategy safeguards you from leaping into risky ventures driven by hype or fleeting trends. If you can't explain how a company operates, generates revenue, and fits within its industry, you might want to pause and reassess. Buffett's philosophy doesn't advocate for blindly following the crowd. Instead, it urges you to be an informed investor. By investing in familiar territories, you position yourself to make well-informed decisions. Think of it as purchasing a business rather than just stocks. If you're confident in a company's potential for growth and understand the factors driving that growth, you're more likely to ride out market fluctuations with confidence. Consider the simplicity of this principle. If you use a certain product or service in your daily life and can see its value, chances are others do too. Warren Buffett's strategy essentially taps into this relatability, the notion that if something makes sense to you, it's likely to make sense to others as well. In a world of complex financial instruments and speculative endeavors, invest in what you understand, acts as your anchor. It keeps your decisions grounded, focused, and aligned with your areas of expertise. As you traverse the investment landscape, take a page from Warren Buffett's playbook and remember, your wealth grows not by chasing the unknown, but by nurturing the familiar. Value investing is a strategy that involves identifying companies that are trading at prices below their intrinsic value. In simple terms, it's like finding a great deal in the stock market, buying $1 for 50 cents, if you will. When it comes to value investing, Warren Buffett is the undisputed champion. His success is based on his long-term perspective and his keen eye for undervalued opportunities. He's often referred to as the Oracle of Omaha, due to his incredible track record. Buffett doesn't just buy any companies at discounted prices, he focuses on good companies. These are businesses with strong fundamentals, competitive advantages, and solid growth potential. He looks for companies that are well managed and have a history of generating consistent earnings. Now, here's the real secret sauce: buying at discounted prices. When the market temporarily undervalues a good company, Buffett sees it as an opportunity to buy in at a lower cost. This margin of safety ensures that even if the stock price fluctuates, there's a cushion against potential losses. One of the key takeaways from Buffett's strategy is his emphasis on the long term. He's known for holding onto his investments for years, sometimes even decades. This patient approach allows his investments to ride out market volatility and capitalize on the company's growth over time. Warren Buffett's value investing strategy is all about buying into good companies when they're trading at discounted prices. By focusing on long-term growth, solid fundamentals, and a margin of safety, he's been able to build an impressive track record over the years. So, whether you're a seasoned investor or just starting out, taking a page from the Oracle of Omaha's playbook could be a valuable move for your portfolio. If you found this video helpful, don't forget to like and subscribe for more investment insights. And remember, before making any investment decisions, do your own research or consult a financial advisor. Picture this: a castle with a deep, protective moat around it. Warren Buffett sees companies like these castles, and the moat represents their competitive advantage, something that sets them apart from the competition. There are different types of moats. First, the cost moat, where a company can produce its products or services at a lower cost than competitors, giving them an edge. Next, the network moat, where a larger user base or network effect makes it hard for others to compete. And then, the intangible moat, where strong brands, patents, or regulatory advantages protect a company. Think Coca-Cola, its brand and secret formula are unreplaceable. Or consider Apple, their ecosystem and loyal customers create a strong network moat. See's Candies is another example. Their focus on quality lets them charge premium prices. Buffett's genius? He doesn't chase fads. He looks for enduring advantages that will last. These moats help companies maintain profitability over time, which means steady growth and less vulnerability to market fluctuations. So, when you're investing, remember the moat strategy. Focus on companies with sustainable competitive advantages. It's not about the latest trend. It's about finding those castle-like businesses that can weather the storms of the market. Margin of safety, protecting yourself from downside risks. What exactly is the margin of safety principle that Warren Buffett emphasizes in his investment approach? Well, put simply, it's all about protecting yourself from downside risks. In other words, when you invest, you want to buy a stock at a price significantly below its intrinsic value, giving you a margin of safety in case the market goes south. Now that we know what it is, let's break down the key elements of the margin of safety strategy. Intrinsic value calculation. Warren Buffett famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This means that before investing, you need to calculate the intrinsic value of a company, essentially, what it's truly worth. Once you've calculated the intrinsic value, you should aim to buy the stock at a price significantly below this value. This discount acts as a buffer in case the market undergoes a downturn. Avoiding speculation. Buffett advises against investing purely based on speculation or hoping for quick gains. Instead, he encourages focusing on the company's fundamentals, its competitive advantage, and long-term potential. The Coca-Cola investment. One of Buffett's most famous investments is in the Coca-Cola Company. He bought a significant stake in the company when its stock price was trading at a substantial discount to its intrinsic value. This not only provided him with a margin of safety but also allowed him to benefit from the company's long-term growth. The 2008 financial crisis. During the 2008 financial crisis, Buffett's Berkshire Hathaway invested $5 billion in Goldman Sachs. This move showcased his adherence to the margin of safety principle. He saw an opportunity to buy into a solid company at a time when its stock price had been beaten down by market panic. The importance of patience. Another critical aspect of Warren Buffett's strategy is patience. He's known for his famous saying, "The stock market is a device for transferring money from the impatient to the patient." The margin of safety strategy requires waiting for the right opportunities and not rushing into investments without proper evaluation. Warren Buffett's margin of safety strategy is all about minimizing downside risks and focusing on the long-term potential of companies. It's not about chasing quick gains but rather about calculated and patient investing. What sets him apart is his long-term, value-based investment philosophy. Unlike the rapid-fire trading of some investors, Buffett's approach revolves around seeking out companies that exhibit strong financial health and stability. How does Buffett's strategy actually work? Well, let's look at some proof-based evidence that underscores the significance of focusing on financial health. Buffett's investments often center around companies that consistently generate earnings over time. This provides stability and a strong foundation for future growth. Buffett's companies tend to have a low debt-to-equity ratio, indicating that they're not heavily burdened by debt. This reduces financial risk and enhances the company's ability to weather economic downturns. Warren loves businesses that generate strong cash flows. Why? Because a healthy cash flow not only ensures the company can operate smoothly but also provides the opportunity for reinvestment and expansion. Many of Buffett's investments are in companies with a history of paying consistent dividends. This not only signifies financial stability but also rewards long-term shareholders. Now, let's talk about why focusing on financial health is so convincing, especially for long-term investors. By investing in companies with robust financials, you're inherently reducing the risk of a catastrophic loss. Even during market downturns, financially stable companies are more likely to withstand the storm. Companies that are financially healthy have the resources to invest in innovation, expansion, and adapting to changing market conditions. This positions them for sustainable growth over the long haul. As an investor, knowing that your money is parked in companies with strong financial foundations can provide peace of mind. It allows you to weather volatility without constantly worrying about the value of your investments. So, how can you practically implement Warren Buffett's strategy of focusing on financial health and stability? Here are a few steps. Dive into a company's financial statements, debt levels, and cash flow. This will help you gauge its overall health. Adopt a patient approach. Think of your investments as a partnership with the company and give them time to grow and mature. It's not about how many investments you have, but rather the quality of those investments. Choose a few strong contenders rather than spreading your resources too thin. The proof-based approach of consistent earnings, low debt, and strong cash flow speaks volumes. The convincing factor lies in risk mitigation, long-term growth potential, and the peace of mind it brings. So, as you venture into the world of investing, remember to take a page out of the Oracle of Omaha's playbook. If you found this video helpful, don't forget to like and subscribe for more investment insights. Thanks for tuning in, and until next time, stay financially savvy.